What if you could trade an entire sector of the global economy as easily as, I don't know, buying a single cup of coffee?
Right, like just tapping your phone and owning a piece of the whole market.
Exactly. Welcome to the show, everyone. Today is Tuesday, May 5, 2026, and we are working with verified research data that was freshly collected this very month, May 2026.
Fresh off the presses,
Like
which is
that.
crucial because this space moves incredibly fast.
It really does. I am thrilled to welcome you to Macroeconomy AI, and today's deep dive is titled ETFs, What They Are and How They Work. Today, we are breaking down a nearly $20 trillion industry that has, frankly, completely rewired global finance.
It's an absolutely fascinating evolution. I mean, the scale of this market and the underlying mechanics that keep it running are things every modern investor really needs to understand.
Yeah, not just on a surface level, but how the actual plumbing works.
Exactly. The plumbing is everything.
Absolutely. Before we jump in, a huge thank you to you, our listener, for joining us today. We also want to thank the sponsor of today's deep dive, Sponsor Name.
Yes, big thanks to them.
Bringing a compilation of analyses and news on macroeconomics, technology, and artificial intelligence, Macroeconomy AI is proud to partner with Sponsor Name. They are your go-to platform for seamlessly integrating artificial intelligence into your daily financial workflows, helping you stay ahead of the curve.
Which is more important now than ever.
Definitely. Okay, let's unpack this. Our mission today is to understand the mechanics, the massive growth, and the hidden risks of ETFs, all based on a highly verified economic research report from this month.
So to start us off, I think we really need to look at the blueprint of this financial juggernaut.
Yeah, lay the foundation for us.
Right. To anchor ourselves, we first need to define what an exchange-traded fund, or ETF, actually is. Legally and functionally, it is a hybrid.
Like a mashup of two different financial products.
Exactly. It's an open-end investment fund, meaning it holds a portfolio of underlying assets, like stocks, bonds, or commodities. But unlike a traditional mutual fund, where you buy in or cash out just once a day at a set price, an ETF's shares are traded on an exchange all throughout the business day.
Right, exactly like a common stock.
Yep. You just buy and sell the ticker whenever the market is open.
Think of an ETF like a digital variety pack of investments. You know, you get the whole assortment, but you can buy or sell the entire box instantly during trading hours.
I like that.
Yeah, you don't have to go to the market and buy the chocolate, the vanilla, and the strawberry all separately. You just buy the prepackaged box.
That's a really good way to look at it. But it's actually a bit more complex than a static variety pack,
Yeah.
because the contents of this box are constantly shifting.
Oh, right, the rebalancing.
Exactly. The fund manager has to constantly rebalance the assets inside to match whatever index they are tracking. And what's fascinating here is how recently the rules governing this dynamic variety pack were actually streamlined.
Wait, really? Because ETFs have been around for a while, haven't they?
They have, yeah. Dating back to 1992, actually. But for a long time, the regulatory framework in the U.S. was incredibly fragmented.
Fragmented how? Like different rules for different funds?
Precisely. Because there was no single comprehensive rule for them, the Securities and Exchange Commission, the SEC, had to issue more than 300 individual exemption orders just to allow different ETFs to operate.
Over 300. That sounds like a bureaucratic nightmare.
Oh, it was immense administrative friction. Imagine trying to run a dynamic global financial system where almost every new product needs a bespoke, custom permission slip from the government.
Wow. So when did that finally change?
It wasn't until late 2019 that the SEC adopted Rule 6011, which finally created a unified, transparent, and efficient regulatory framework.
So Rule 6011 essentially cleared the runway for everyone.
It really did.
And looking at the numbers from our May 2026 data, that modernization paved the way for absolutely explosive growth. I mean, by the end of December 2025, global ETF assets hit a record-shattering $19.85 trillion.
It's just a staggering amount of capital.
Right, and that capital is spread across more than 15,600 different products worldwide.
Massive numbers. But, if you look closely at that almost $20 trillion pie, you see a really heavy concentration of power.
Oh, for sure. Just three corporate giants basically hold the knife.
Right. BlackRock, primarily through their iShares brand, Vanguard, and State Street's SPDR ETFs. Those three collectively control almost 60% of the entire global industry.
Which naturally brings up a major mechanical question for me.
Okay, let's hear it.
Well, if these three giants are managing these colossal piles of money, how does the actual slicing work? Because if I buy an ETF that tracks the S&P 500 on my brokerage app, I expect the price of my ETF to perfectly match the value of the 500 stocks inside it.
Right, that's the whole appeal of the product.
But since the ETF itself is trading on the open market, shouldn't regular supply and demand cause the price to drift away from the actual value of those underlying assets? Like, if everyone suddenly wants the ETF wrapper, the price of the wrapper goes up, right?
That is the ultimate operational question of the ETF industry. And the secret engine that keeps the ETF price perfectly anchored to its net asset value, or NAV, is a mechanism called creation and redemption.
Creation and redemption sounds very dramatic.
It is, in a financial sense, and it relies on a very specific, exclusive group of institutional players known as authorized participants, or APs.
Right, so these APs are large financial institutions, and they are the only entities actually permitted to create new shares of the ETF or redeem existing ones directly with the fund manager.
Exactly. You and I can't do that. We just trade the existing shares on the secondary exchange.
So the APs are the ones under the hood.
Precisely. And these APs keep the price stable through continuous arbitrage.
Okay, walk us through exactly how that works in real life.
Sure. Say a sudden surge of retail buyers pushes the price of an ETF higher than the actual underlying value of its assets. The ETF is now trading at a premium.
Right, it's overpriced.
Yep. So an authorized participant looks at their screens and sees a risk-free profit. They go out into the market, buy the underlying stocks or bonds, hand that basket of assets to the ETF manager, and in exchange, they create new ETF shares.
And then they take those newly minted, overpriced shares and just dump them onto the open market to capture the profit, right?
Exactly. By flooding the market with new shares, they increase the supply, which immediately pulls the ETF's price back down until it perfectly matches the underlying net asset value.
That's incredibly elegant.
It is. And if the ETF price falls too low, they do the exact reverse, buying the cheap ETF shares, redeeming them for the underlying stocks, and selling the stocks.
Wait a second, though. That sounds, well, incredibly fragile.
How so?
This entire $19 trillion market stability relies on a few massive financial institutions constantly playing referee to capture tiny, momentary profit.
That's essentially it, yeah.
What happens if an AP just decides to pack up and go home during a massive market crash? I mean, if things get too volatile and they stop doing the arbitrage, doesn't the whole price-matching mechanism just break down?
If we connect this to the bigger picture, your skepticism is entirely justified. And we actually have empirical data to prove your point.
Oh, really? We've seen this happen.
We have. A 2025 academic study published in Science Direct analyzed exactly this scenario by looking back at the March 2020 Dash for Cash crisis.
Ah, right, when the pandemic hit and the markets panicked.
Exactly. The researchers found that during periods of severe market stress, APs aren't immune to panic. Because they are banks with their own balance sheet limits and capital constraints, when the market gets too rough, they actually do step back.
So they just leave the field. They stop refereeing.
Yes. They severely reduce their arbitrage activities. This was specifically documented in corporate bond ETFs.
So what happened to the prices?
Well, during the 2020 crash, the underlying corporate bonds became highly illiquid. The APs didn't want to risk holding that toxic inventory even for a moment to execute the arbitrage.
Wow, so they just sat on their hands.
Right. As a result, the APs who were normally the most active reduced their participation, leading to massive gaps between the ETF price and the underlying asset values.
So the referees absolutely can leave the field when the weather gets bad. That is an incredible vulnerability to keep in mind.
It definitely is a structural risk.
Okay, so if these APs and fund managers are constantly moving assets around to keep this system stable, it makes me wonder who is footing the bill. I mean, running a $20 trillion machine isn't a charity.
Definitely not. There are fees involved.
Let's talk about the costs, specifically the invisible wealth killer known as the total expense ratio, or TER.
Right. The TR represents all the operational costs of the ETF. That's your management fees, administrative expenses, licensing, and so on.
But why is it called an invisible fee?
Because you never get a direct invoice for it. It is deducted continuously from the fund's net asset value.
Okay, let me try to visual here for our listeners. Think of the ETF's value like a giant bucket of water holding your investments. You never get a bill in the mail for the bucket's upkeep, right?
Right.
Instead, the fund manager just takes an eyedropper and skims a tiny drop of water off the surface every single day. You don't notice the single drop missing, but over a decade, the water level is noticeably lower than it would have been.
That is a perfect visualization, and the size of that eyedropper matters immensely.
That's where the fee wars come in. Right.
Exactly. This is where the industry fee wars come into play. By the end of December 2025, Vanguard's average fee for their ETFs was a microscopic 0.04% per year, weighted by assets.
0.04%. That is wild.
Right. And to put that in perspective, the broader industry average was roughly 0.23%.
And while the difference between 0.04% and 0.23% sounds like rounding error, the math over the long term is brutal.
It really is. The compounding effect is huge.
Let's bring that math to life for you. The source material highlights a great compounding example. Imagine you invest $10,000 at a 7% annual return over 20 years.
Okay, pretty standard benchmark.
If you choose an ETF with a tiny 0.03% eyedropper, you end up with about $38,700.
Nice.
But if you choose an ETF tracking the exact same assets, but they use a 0.50% eyedropper, you only end up with $36,200.
Ouch.
Yeah, that is a $2,500 difference just because you picked the wrong wrapper for the exact same underlying assets.
It's a stark illustration of how costs relentlessly eat into compounding returns over time.
It really makes you pay attention to the fine print.
Absolutely. Now, I must emphasize here that these numbers are purely illustrative to demonstrate the mathematics of compounding. None of this constitutes investment advice, and future returns are never guaranteed.
Of course.
But strategically, it explains why the industry has been racing towards zero fees for basic, passive index trackers. Investors have simply woken up to the math.
Here's where it gets really interesting, though. We just established that ETFs won the financial world by acting as cheap, passive, boring index trackers.
Boring but effective.
Right. But looking at the 2025 and 2026 data, the industry seems to be rapidly mutating into a vehicle for much riskier, more complex products.
Oh, completely mutating.
It's like taking a reliable family minivan and suddenly dropping a Formula One engine into it. We are seeing a massive shift away from passive indexing and into crypto, active management, and dynamic emerging markets.
The evolution is undeniable. Let's look at the crypto frontier, for instance.
Oh yeah, the Bitcoin spot ETF.
Exactly. A major historical pivot occurred in January 2024 when the US SEC officially approved Bitcoin spot ETFs.
Which changed everything.
It did. It allowed traditional investors to buy direct Bitcoin exposure through standard brokerage accounts without dealing with digital wallets or, shady crypto exchanges.
The influx of capital there was unprecedented, wasn't it?
It broke records. BlackRock's Bitcoin ETF, ticker iBright, reached $100 billion in assets under management in a record-shattering 435 days.
435 days to hit 100 billion.
Yes. And for context, the previous record for an ETF to hit that milestone was 2011 days.
Wow. So the crypto wrapper completely obliterated the old record.
It wasn't even close.
But it's not just crypto assets, right? The fundamental philosophy of the ETF itself is changing.
Right, the move to active management.
Yeah, we used to think of ETFs as strictly passive blindly, following the S&P 500 or the NASDAQ without human intervention. But now, active ETFs are the fastest growing subcategory globally.
It's a huge shift in the landscape.
By late October 2025, active ETFs hit $1.82 trillion in assets. And even more wildly, over the last 12 months in the US, active ETFs made up 85% of all new ETF launches.
Which is just a massive takeover of the new product pipeline.
But how does an active ETF even work? Doesn't a portfolio manager have to publish their holdings every day, basically showing the entire market their secret trading strategy?
Well, that was the hurdle for a long time. Active managers hated the transparency requirement of traditional ETFs.
Naturally, they don't want people copying their homework.
Exactly. But the industry developed what are known as semi-transparent or non-transparent ETF structures.
Ah, so they found a loophole.
Basically, this allows portfolio managers to shield their daily trades from the public, only disclosing their full holdings on a delayed basis, much like a traditional mutual fund.
Oh, that makes sense.
Yeah, they realized they could deliver their active stock-picking strategies within the tax-efficient, easily tradable wrapper of an ETF without giving away their intellectual property.
And this active innovation isn't just a U.S. phenomenon, is it?
Not at all. If we look at the Brazilian market, for example, the underlying structural shifts are phenomenal.
The numbers coming out of Brazil are wild. Their ETF market leaped 68.5% in a single year.
Which is incredible growth.
Jumping from 54 billion reais in 2024 to 91 billion reais by the end of 2025. And unlike the U.S., which is heavily focused on equities and stocks, the Brazilian boom was driven largely by fixed income ETFs.
Right, specifically those tracking the Tesouro Selic, their government bonds.
Why this sudden explosion in Brazil specifically, and why fixed income?
It comes down to the specific macroeconomic environment and tax incentives in Brazil. Brazil operates in a uniquely high interest rate environment, the Selic rate.
Okay.
For a long time, investors just bought direct government bonds. But fixed income ETFs offer a structural advantage there.
Like what? Better returns.
More like better efficiency. They provide higher liquidity, and more importantly, they offer specific tax efficiencies compared to holding the bonds directly.
Ah, taxes. It always comes back to taxes.
Always. Especially regarding the deferral of taxation until the sale of the ETF. Investors did the math and flocked to the more efficient wrapper.
And the product innovation there is moving incredibly fast, too. In 2025, Brazil launched JOE-11, which is the first hybrid ETF in the country, combining both fixed and variable income in a single ticker.
They're getting very creative.
They really are. They also launched NBIT-11, which is based on Bitcoin futures. And importantly, the Brazilian regulator, the CVM, has announced that specific regulation allowing for domestically listed active ETFs is expected by 2027.
It just shows how universally adaptable the ETF structure really is, adapting to local interest rates, tax laws, and investor appetites.
It's incredible to see. But, as we watch these products mutate from simple broad market index trackers into complex hybrid funds, Bitcoin futures, and heavily managed active funds, we have to bring things back down to earth.
We do. There's no free lunch in finance.
Exactly. These aren't just magic, frictionless money-making machines. They have specific documented vulnerabilities. So let's unpack the blind spots. What are the structural risks of these new vehicles?
That is the crucial final piece. We have to acknowledge the strategic risks embedded in these complex products. The first major blind spot is tracking error.
Okay, so that's the difference between the return of the ETF and the actual index it claims to track.
Right, because if you buy a gold ETF, you expect it to exactly match the price of gold.
Exactly, but it rarely does perfectly, does it?
It doesn't. Tracking error is relatively minor in simple, highly liquid equity funds, but it becomes a severe risk in complex products, like leveraged commodity ETFs or funds tracking highly illiquid corporate bonds.
Because of the underlying friction. Things like cash drag.
Right.
Right, because the fund always has to hold some uninvested cash.
Yes, cash drag, management fees, and the continuous cost of rolling over futures contracts.
Yeah.
All of those can cause the ETF's performance to drift significantly from the actual asset it tracks over time.
Got it. And then there is liquidity risk.
That's a huge one.
Just because an ETF trades on a major exchange doesn't mean it is easy to buy or sell at a fair price. We talked earlier about how APs step back during a crisis.
Right, the vanishing referees.
Exactly. If you are trading a niche thematic ETF with very low daily trading volume, you might encounter massive bid-ask spreads. You could end up paying a hefty premium just to get into the trade.
Or taking a steep discount when you desperately need to liquidate and get out. The liquidity of the ETF wrapper can never exceed the liquidity of the underlying assets it holds.
That makes total sense. And for international investors, we have currency risk too.
Very important point, especially in emerging markets.
Going back to our data on Brazil, many investors there buy BDR's Brazilian depositary receipts of foreign ETFs.
Right.
These are quoted and traded in the local currency, the real, but the underlying assets of the ETF are priced in US dollars or euros. If the exchange rate swings violently against you, that currency devaluation can completely wipe out the operational gains of the ETF itself.
It's a huge variable that people sometimes overlook. And then finally, there is thematic risk or concentration risk.
This goes against the whole original point of an ETF, right?
It really does. The original superpower of the ETF was cheap, broad diversification, buying the whole market.
But now?
But if you buy a hyper-specific ETF that only tracks, say, emerging market robotics companies, you are making a highly concentrated bet.
You've completely lost the safety net of diversification.
Exactly. And you are fully exposed to the extreme volatility of that singular narrow sector.
This raises an important question. Do investors truly understand the liquidity and concentration risks they are taking when they buy these complex thematic products?
It's a valid concern. The sheer ease of clicking buy on a modern brokerage app can easily mask the underlying complexity of the asset.
Too easy sometimes.
Too easy. And again, it is vital to note that this analysis is provided to give you strategic insights into how the market mechanisms function, not to provide investment advice.
Definitely. So to summarize our strategic insights today, The ETF architecture has undeniably democratized access to global markets.
Without a doubt.
It has drastically lowered the barrier to entry and the cost for everyday investors to access assets that were previously locked behind institutional doors.
It's been a revolution.
But as these products have mutated into active and highly concentrated vehicles, they have introduced entirely new systemic complexities and hidden costs.
They absolutely have.
Now, before we wrap up our deep dive, we have a mandatory disclaimer to share from our research sources. This material is a compilation of open projections and information from third-party sources and is purely informational and educational.
Right. It does not intend to present any ideological bias.
Exactly. It does not constitute an investment recommendation or financial advice of any kind.
And remember, projections are subject to frequent revisions according to new information obtained, new external facts, and even new narratives.
Likewise, past performance is no guarantee of future performance.
Well said. And as a final thought to leave you mulling over today, we started this conversation by marveling at how ETFs revolutionized the financial industry by offering cheap, passive, transparent index tracking.
Right, the cheap variety pack.
But now, with active ETFs growing at an explosive rate, making up 85% of new launches in the US, and the fees creeping slightly higher on those specific, heavily managed products.
Are we just going in circles?
That's the question. Are we slowly just recreating the old, expensive, opaque mutual fund industry, but disguised inside a shiny new ETF wrapper?
That is a brilliant question and a perfect place to leave it for today. That was today's Macroeconomy AI. We'll leave it here. You all stay well and keep an eye out for our new broadcasts. Subscribe to our channel, access the links, and follow Macroeconomy AI on social media.
Bye.